live. Okay, this is exciting. We're going live on CJ Wallace's YouTube channel. This is really cool. Credit Banking Mastermind number 5. This is exciting. Okay. Now, all right. So we are, I better open up my window here. Ooh, we got a lot to talk about today. This is exciting. Giving some people on YouTube a few minutes to jump in. Want to thank also in our webinar, I want to thank Ray and Latha for already being here. This is very, very cool. We've got there's so much to cover when we're talking about credit banking. Last week we covered credit scores with Mr. Ray Fleming. That was a really good topic because, you know, I bet you some of you might have known a lot of that, but I bet you we went over some stuff that you'd never heard of before. It's so critical to know and understand our finances, because if we don't, we're at the whim or the control of other people, such as like the bank. If the bank tells you that you're, they'll tell you, well, based off your finances, you can only do this, or you can do this, or you can't do this. If we don't know our finances, then we're just going to believe them. So it is very critical that we know and understand our finances here. Now, I want to share my screen with you, and I'm going to here in just a minute. I'm waiting on lovely technology to catch up here. So, gotta love it though. All right, praise the Lord. I love technology when it works. So we're talking about tonight credit banking. Now, for some of you that are on this channel, like, wait a minute, this is on YouTube. This is the Velocity channel. This is CJ Wallace's YouTube channel. What's credit banking? Credit banking, velocity banking, mortgage sweep strategies, cash flow banking, infinity banking. There's a lot of different terms, and they, in many ways, mean some of the same things. It's just a strategy that we use to help people learn how to use your lines of credit as a form of banking. How do you run your use it as your checking account, use it as your savings account, and then you take these lines of credit that you have, or credit cards, and you're able to use these lines of credit, these tools, to pay off the debts that you have. And so again, someone's like, what? Okay, so here's what we're talking about. It's all about how the debt is amortized, right? The debt can be amortized many different ways, and a lot of times on a loan, the interest is what we call front loaded. So in the first 22 years of a loan, you're always paying more money towards the interest. So this is obviously a problem. So what we're going to try to do, while the interest remained the same, it's how the interest is amortized. So interest on a line of credit, very simple. It's an APR, an annual percentage rate, and the interest on loans and lines of credit can also be simple. And we'll go over some of those formulas, of course, that highlight and show how the relationship between the different ways that credit is amortized. A non-amortization would be like an interest-only loan that has certain benefits, can also have certain drawbacks. But what we're talking about primarily here tonight is how to use your lines of credit to start attacking the loans where the interest rate is amortized. Because early on in a loan, you might be paying upwards of effectively 80%, 300%, right, uh, of interest in the earlier parts of the loan, depending on how it's amortized, and that can be very expensive. So if there are ways that we can aggressively pay down your debt card, can end up actually saving ourselves a lot of money. So I was going to go over today the topic of budget. We're going to talk about budget today, but you know what? I'm going to push that off to next week. And don't worry, if you were turning in like, wait a minute, I wanted to hear about budget. There's a lot of time, and if you have questions about it, we can definitely go back and cover that. Usually when we talk about budget is we really dive in deep to try and find ways to free up cash flow, because there's a lot of different components to doing a credit banking strategy, one of which is freeing up your cash flow. So what we're going to do today is actually cover a strategy called, we're going to call it using credit banking with business credit. And I want to show this as a strategy. This is an advanced strategy, but it's something that we use many times to help our clients, especially who have some different credit challenges or difficulties, see how they can start accessing this strategy. And so, so that's really what we're primarily going to cover today. And I definitely want to make sure that we're all on board. I apologize for the delay, as I've just had to reload a webinar that I thought was on my laptop, and then all of a sudden, whoops, it's gone. So, okay, folks, we are ready to go. Let me go ahead and see if I can bring back now. Here we go. I'm going to share my screen. This should be good, hopefully. Boom. All righty. And share. So the good news is now you should be able to see my screen. All right, perfect. I can see now where that's at. So let's go ahead and dive in. There's so much that we can talk about. We usually cover talking about budget. We talk about the differences between lines of credit, and we talk about loans and the amortization. We go through the math. We talk about the actual strategy of credit banking itself, which let me tell you, if you've never done this before, it seems kind of weird, because you take all of your income and you put it on your line of credit. A lot of people are like, whoa, how are we going to do that? So this is a part of what we're talking about: credit banking and the search for the lost American dream. You're tuning in tonight on this webinar, and we thank you to CJ Wallace for allowing us to be on your YouTube channel. We are the Wise Guys in Ties. CJ Wallace has us come over and do some add some tremendous value to you folks and train you on the topic matters such as credit banking, which on this channel, I believe you call it velocity banking. Six dozen or what, half a dozen of one, six of another. All these names are a bit synonymous. Now, this is my information that's up there, my business partner, Ray Fleming, and we're the Wise Guys in Ties. We help people implement credit banking strategies, and we help people also implement business credit strategies. And if you're interested in working with us, our contact information is there on your screen. If you're interested in working with CJ Wallace, you can always get a hold of him at creditwiz@investorpro.org, so that he can also give you a lot of good tips, tricks, and strategies on how to do velocity banking. So this credit banking webinar, how do you participate? So this credit banking webinar is very unique because it's interactive. We want you to feel like you can be a part of this. And so how do you be a part of this? Well, you have to go to wiseguysandties.com/credit-banking. I can bring that up a little bit bigger on your screen. wiseguysandties.com/credit-banking. When you do, there's a form here to fill out. You put your name, your email, your phone number, and you have to check mark each of those 4 boxes because we live in a world where people are going to sue you. I am trying to help tonight facilitate a mastermind, a discussion on the topic of credit banking and business credit. I want you to know that I am not a licensed financial advisor, not a financial planner. I'm not a fiduciary. I'm not a CPA. I'm not an attorney, and I'm not practicing any law. I'm not giving any specific advice that you should take tonight. This is general in scope, general in nature, and is meant really for you to absorb and learn some of these different strategies, but then take these strategies and talk to the professionals in your life to see if it really is something that you can implement for your business. I'm just a successful business owner that has had some success over the last few years implementing these strategies, and we've helped literally hundreds of clients implement these same strategies and achieve some pretty wild success. And so what I'm covering tonight on this webinar is the different strategies that we cover. So we don't go over everything in one little webinar. The way the webinar works is you fill out your information. Then below, as you scroll down the screen, you can put in your financial information if you want to. You're not required to. But one person that fills this out every week, we go over their numbers. So we have a lot of people that submit this form and they want to participate in the mastermind. So here's the beauty of how it works. We open up the mastermind for the first, I don't know, say 20 minutes or so. We're going to discuss a strategy or a topic and put that out there for you to really chew on and digest. And then after that, we're going to open it up to questions. And you feel free to type in your questions as we go. I'll do my best to pause every time I can and answer those questions. You know, I'm really grateful to see so many people on the webinar, as well as we have people on the YouTube channel. So that's good to see as well. So what happens here is once you share your information, then we open it up to everybody. So we'll show the finances. Now there's full anonymity. We don't share any names. We don't talk about anybody's specific accounts. We're just going over the raw numbers. And the goal is to have you on this mastermind start talking about, well, what would you do in this situation? What's the first steps? What would you do next? What are some ways where we could think outside the box? I just facilitate the mastermind at that point as different people chime in and share what they think. The way you do that is if you're on YouTube, you just type in answers to or questions that are asked. If you're in the mastermind, same thing. You just go into the chat feature on the webinar and type in your questions there, or the different responses that you have. The goal is we start a robust discussion, and the person is hearing different viewpoints from different people who have different opinions on what they think that should be done with these set of finances. Then at the end, I'll talk about maybe a strategy that I might do. And we'll go over some of the analytics of how we would actually implement credit banking as an actual strategy. And then, folks, we call it a night. That's really how simple it is. So if you want to participate specifically, you want to get into the webinar side and you want to be able to, because we start this webinar up usually about 15 minutes before the hour, there's an opportunity to chat or talk with myself or Ray. The reason why we're doing this, the reason why we have a credit banking webinar that we do once a week, we do this every Tuesday night, 7 p.m. Mountain Standard Time, 9 p.m. Eastern Standard Time. We do this because we literally have hundreds of clients. We can't meet with everybody one-on-one. Some of our clients, we do meet one-on-one and we do work with them. But for a lot of people, they just don't have the time or they can't afford to pay for one-on-one consultations with us. So what we do is we set up this time. This is a time where everybody can kind of interact and work together. And it's a great opportunity for me to be able to reach out from one to many and be able to get this information out, because there's a lot of people who need this information, and they're just stuck. And so we want to help all of our clients get out of debt and free up their cash flow so that they can start a business, or if they already have a business, that they can create massive income and save massive amount of money on taxes, that they can actually fuel their dreams. I mean, it's my goal, my hope, that we are a blessing to you, because Ray and I see it as we've been placed here by God to help you figure out, not figure out, but whatever your purpose is, we want to give you the tools and the resources to do it. I mean, why are you here? What's your purpose in life? Are you living it, or are you stuck in financial despotism, right? If you want to achieve that financial freedom, then we want to help you to do that. And so the way that we do that is we provide the resources and the tools to help you to do that. So this is a free webinar where we discuss a lot of strategies and tactics that you can use in your life. You just need to make sure you do your own diligence and check and make sure that this will work for you in your situation. So if you want to participate, you want your numbers that we discuss, then you just go to credit banking. Well, you go to wiseguysandties.com/credit-banking, and then you'll be able to get all the wonderful information, or you'll be able to give us this information, and then we'll be able to take this information and you can be a part of the webinar. Now, we do not share any information. I don't even contact you if you don't want me to. I only contact you if you want me to. That's why you put your contact information there. I don't have anybody I'm selling this to. No one's buying any of this information off of me. And when we share people's numbers, we don't put any identifying information there as well. It's only so that we can communicate if you want me to. And then as well as being able to get a free consultation. So some people, they do want to work with us. We do make time to do a free 30-minute consultation with folks that are looking just to kind of get their bearings. So where do I start? Well, if you're going to do a 30-minute consultation with us, you have to fill out this form, okay? Because I'm going to spend all 30 minutes collecting the information from you, and we won't accomplish anything. So if this form's already filled out and we do a 30-minute consult, we can really discuss some of the strengths and challenges that we see, and hopefully give you some good ideas or a direction pointed in where you can begin to get educated and know what to do, and figure out the resources that you need to get that done. All right, folks, let's move in to what is financial freedom? Well, financial freedom happens when your passive income equals your monthly expenses. Monthly expenses minus your passive income equals financial freedom, right? I mean, this should make total sense, right? If for example, if we have $3,000 of expenses and we have zero passive income, then we need to raise $3,000 a month as our financial freedom goal. Once we have $3,000 a month coming in, then we're good. So if we were going to invest to try to bring in the passive income, we need to have a target goal. So they're just simple formulas. If you take your financial freedom goal and you multiply it by 12, you know how much money you need for the year. Now, if you divide that by your rate of return, or what's called your ROI, that will equal the total amount of money you want to invest. So let's look at an example. So if we have a $3,000 a month in expenses, multiply that by 12, then we divide that by, let's say we want to, in our investment, we want to make a 10% return on our money. Maybe you want to be more aggressive and make 20% return on your money. Well, I mean, there's greater risk that comes with that. Maybe you're a little more conservative, like, oh, maybe we just should pull back and go for 5%. Whatever risk tolerance level you're at is the rate of return that you should seek. So the higher the rate of return, the higher risk. Typically, the lower the rate of return, the lower the risk. So we're just choosing 10% here as an example. But when you do the math, if you take 3,000 times 12, and then you divide that by 10%, you come up with $360,000. So if you had $360,000 that you had invested that was earning you 10% a month, that would cover your monthly expenses. So that's I mean, sometimes we just need to figure out, what is the goal? What's the target we're shooting for? Sometimes we're just like, oh, I just want financial freedom. Well, what is that? Let's quantify it. Let's figure out what exactly that is. So yeah, I was going to cover budget tonight. I do want to go over budget, but I'm going to, as I told you, I'm going to skip ahead. We'll come back to budget tomorrow night. I'm going to skip ahead. I want to talk about business credit with credit banking. Now, why are we talking about this? Why aren't we talking about budget? Budget's very important. It's one of the key ingredients to doing credit banking. In fact, there's 3 ingredients to credit banking. You need to have debt, you need to have monthly income, and you need to have a line of credit, right? You got those 3 things, then you can play the credit banking game. However, a lot of people, they don't have all 3 of those, right? They're missing one. Do you think if you don't have any debt, well, then why would you use credit banking, right? Credit banking is a strategy to eliminate debt. So usually that's not what's missing. Everybody's got debt. Okay. And then income. Well, some people are missing that component. Some people just don't have the income. Okay, well, if that's the case, we need to get some income. There's a lot of ways to do that. We're not really discussing that tonight, but credit banking as a strategy, business credit as a strategy, each of those separately and each of them combined can create cash flow. There are ways to do that. And then we have the third component, which is a line of credit. Well, not everybody has access to a line of credit. And many people, well, they have a credit card, but there are some people who don't. So this is why I want to talk about this, because there are a lot of people that have some challenges implementing credit banking, or what CJ calls velocity banking. There are some challenges that some people face. Let's talk about that. Let's talk about my friend Max. Why is he called Max? Max is called Max because he's maxed out. He is maxed out. For the last 2 years, he's been maxed out. He owns his house, and he's been trying this credit banking strategy. How did he do it? Well, as you see on your screen there with the yellow 5,000, that's his income. And so he put all of his income onto his line of credit. And he has $3,000 a month in expenses. So his cash flow, so your cash flow is what's left over after all the expenses have been paid, is $2,000. So he's like, okay, I watched some of CJ's YouTube videos. I've seen the wise guys in ties. All right, I want to try this. But here's Max's challenge. He's maxed out. So these lines of credit, he has a $15,000 limit, right? So all of his credit cards, that's his max limit, but he's carrying a $12,000 balance. He's maxed out. It's been this way for 2 years. All right. And his interest rate on his credit cards is an average of 21% interest. Ouch. So this is his situation, and he sees no way out. How do I get out of it? Then he sees, oh, wow, I saw velocity banking. I saw credit banking. I saw cash flow banking. I've got to try this. So in this example, let's say, well, I mean, so we're looking at, he's maxed out, right? He's maxed out. So what does that mean? His credit score is in the tank. His debt to income ratio is through the roof. His utilization is super high. What do all those mean? Well, your credit score, we covered that last week. You know what a credit score is, and you know what it's like to have a low credit score. Maybe some of you on this webinar tonight have one. DTI, debt to income ratio. How much of your income goes towards paying your debts? Well, I mean, Max is in a situation where he has 60, 70, 80% of his money that comes in goes to paying his debts. What's that like in reality? That's living paycheck to paycheck. That's what the example is, oh, payday's coming up on Friday. And then as you think about it, well, it's really all spent. I've got to pay the mortgage, got to pay the car, got to pay this bill, that bill. And so there's not going to be anything left out of the paycheck once all the bills are paid. So that's a very high debt to income ratio. And then utilization. Utilization is, you have a certain credit limit, like you see down here. He has a $15,000 limit across 3 separate credit cards. So each credit card he has a $5,000 limit. So 3 of them combined, a $15,000 limit. Now on each card, he's carrying a $4,000 balance. So his utilization is at 80%. So when it comes to utilization, that makes up, in terms of your credit score, that makes up in many cases 35% of your credit score, which is why many people who are maxed out have such low credit scores. And he can't get a loan, he can't get himself, say, a HELOC, a personal line of credit, because his debt to income ratio is too high. Because the bank, to lend to you, is going to look at your credit score, and they're going to look at your debt to income ratio and the specific area of your credit score that they have a particular interest in is your utilization. Payment history would be the other. They want to make sure you're paying all your bills on time. So Max is paying all of his bills on time, but I mean, he's just stressed out. And so let's take a look at this. So we talked about his $15,000 limit. Well, we broke those up into 3 different credit cards. So here's one of the credit cards with a $5,000 limit that he's carrying the $4,000 balance on. So when we look at this, we're like, oh, okay, wait a minute. He saw the strategy. We're going to put all of our money, remember, on the line of credit. And so he's like, okay, I'm just going to do what they said. And again, if you watch a YouTube video and then you just do what they said, no, I don't even recommend you do that when we tell you things on YouTube. You want to always check and make sure that that what you're doing fits for your situation, because I'm going to show you something that happens with Max here. So he goes ahead and he puts his $5,000 into his lines of credit, and he decides, okay, this one card, I'm going to pay it all off. I'm going to pay the $4,000 balance down to 0. But look what happens to his limit. Immediately, like the same day, the next day, he pays down that balance down to 0, and then they drop the limit on the card down to $1,000. Now Max is feeling like, I just lost money. I mean, he didn't really lose money because he had to pay off that debt. But using the credit banking strategy, he was counting on having access to the full $5,000 limit of that credit card. He did not anticipate that they were going to shrink his limit. Now, why did that happen? I mean, it's like, wait a minute. He's saying to me, Joseph, you told me this credit banking, this velocity banking works, and I'm telling you, no, it doesn't. So here's the situation. This is why you got to be cautious. Max has been maxed out, as you see on the screen here, for 2 years. So he's been carrying his credit card balances for a very long time at 80%. Now, he pays them down like everybody does, and then life happens and he fills it back up, and he can never quite get below that 80%. But here's the problem. Being over 50% utilization is a negative, and many people on CJ Wallace's YouTube channel know that. But if you're on this webinar and you've never heard that, when it comes to your credit score, once you're over anything over 50% utilization, it is a negative. It begins to it has a negative effect on your credit score. Now, once you're under 50%, it's not necessarily a negative against your credit score. You can actually start growing that credit score. But to speed up how quickly we grow that credit score, you've actually got to get under 30%. And it would be even better to get under 15%, right? We want to utilize no more than 50% of our card. And what I mean by that is within a billing cycle, the balance that carries over from month to month. That's what we're trying to make sure that we do that. That's how we efficiently and correctly use a credit card or a line of credit. Now, in this case, this line of credit has been at 80% utilization for 24 months. The bank thinks you don't quite know and understand how to use that line of credit. So the moment you pay that down, they shrink the limit down because they're like, you need to prove to us that you know how to use this line of credit before we are going to trust you using a line of credit. Now, if Max doesn't know this going in and he just tries it because he saw something on YouTube, oh, ouch, he's going to now start cursing. And sometimes you'll see from time to time, there's always somebody who puts a thumbs down on the like, whether or not, oh, this credit banking, this velocity banking, that doesn't work. It's a bunch. It's because they more than likely were somebody who tried something without getting fully educated and completely understood what they were doing. So this is something that does tend to sometimes hurt people. Now, if you're somebody who's like, well, Joseph, I tried it and it actually worked for me. Great. You were probably in a situation where you weren't over 50% utilization. And if you were, you weren't over 50% utilization for longer than 6 to 12 months. Maybe it just recently went over 50% utilization. That's fine. It's the longer you hold on to that high balance for a long period of time. I mean, you have to read the fine print. Every credit card is different, but it could be if you are over 50% utilization for more than 6 months, the bank might say, well, we reserve the right to decrease your limit. So most people, they get credit cards and they don't read the fine print. And I have to say, I'm one of those people. I actually have somebody like my office manager who I've hired, who that's their job. They read the fine print for me, so I don't have to. But you need to read the fine print. You need to know how these lines of credit work and when these adjustments are made. And they can make changes on the fly. They reserve the right to email you like 30 days in advance. Hey, we're changing we're changing some of the policy on your card. And most of us are like, yeah. we delete the message. But there could be something really important you need to see that they're changing balance transfer rates. They're changing your interest rate, right? That could be an issue. Your utilization, what they're going to do in terms of lowering or your limit. So there's a lot of good things that you you could find out. You need to become your own financial advisor. Now, you don't have to become an expert and get an education in it, like a college degree, but you need to get educated enough so you know what's going on, so that when you do work with a financial advisor, that you know if that person's worth their salt. You know if what they're saying makes sense or is true. We can't just blindly follow what somebody says. You've got to be noble and check to see if what they're saying is true. All right. So Max has got some problems here. So here's one strategy that we do with Max is we encourage Max to start a business. And there's a number of reasons for starting a business, of course. Now, Max could have not started a business, and when he sees the situation that he's in, he could have taken his income and created a secured line of credit. He could have put the $5,000 instead of onto that credit card. He could have gone to the bank and opened a secured account, and then they probably would have given him access to about 90% of the value. So you'd have access to $4,500 of that, and that might be in a CD. Every bank is different. You got to make sure you read all the fine print with that too. But there's a lot of banks, and if you're looking for resources, I mean, that's really what this mastermind's for. We might have some people share, yeah, I worked with this lender, I worked with that bank, and they gave me this or that. Yeah, feel free to share. I mean, we're not soliciting for funds. We're not promoting any specific banking institution or product here, but hey, this is a mastermind. This is for you. So if somebody had some success and they say, oh, hey, check out this bank, Just don't go blindly. "Oh, yeah, I'll just go in the bank and do it," but check it out. See if that'll work for you. There's a lot of great institutions out there, and so there's a lot of great options. Now, an option that I wanted to discuss tonight is there's a certain type of synergy between building business credit and using a credit banking strategy. They actually can work quite well. They're totally two different financial type of strategies, but they work so well together. They create a type of synergistic effect that just really, it's like rolling a small little snowball down the mountainside and having it turn into an avalanche, right? And this is, in terms of growing your wealth or your finances, that's what we would like to see happen, right? So, and so this is also an advanced strategy. What do I mean by that? I mean that this isn't something that you just sort of wing it and like, I'll just kind of figure this out as I go. I completely recommend using professionals. Get a CPA, get an attorney to help you set this up the right way. Make sure that you have real estate professionals, because this strategy I'm going to show you uses a little bit of real estate. And so I want you to I want you to know that you do this on your own. Maybe you think you're saving money, but you might end up costing yourself in the long run. I always endorse working with professionals because they do charge money. It's never cost me anything to work with a professional. I mean, I have an insurance guy, I've got attorneys, and when things happen, I'm a real estate investor, and I have to do an eviction. Well, I've set my business up the right way, and I've structured my leases the correct way that we can simply go through the process, and it's very easy. If I winged it and just, I don't know, went to some online website to form my business and get a generic lease off the internet, I might not be well protected. And there's a lot of different ways to pierce the corporate veil. And what that means is people can sue you. And if you didn't set your business up the right way, you can become liable, and you don't want that. So I recommend hiring professionals because they are worth their weight in gold. The right professionals, good professionals. And that's another reason for this mastermind. Let's share different professionals that we use. This is meant to be as much of a networking opportunity for people as anything else. What I just recommend is that we don't focus on selling anybody anything here. I'm not trying to sell anybody. We just want this to be a lot of personal testimonials. If you use somebody or some service and it worked for you, great. And you feel free to share that. And anything that's shared, whether it's in the webinar or it's online in YouTube, keep in mind that that's not an endorsement or a recommendation of Wise Guys and Ties, and that's not an endorsement or a recommendation for CJ Wallace and his Velocity channel. Okay. Again, we live in a litigious society, so I always got to say all of these little things because we want to make sure we're doing everything right. So back to our story of Max. We have here, we tell Max, hey, let's start a business. Maybe Max already has a business, and maybe that's one of the reasons how Max got in this situation. I can't tell you how many people that we help who have a business, and the reason why they became Max is they use their own personal credit to fund their business. And now they're like, oh man, I'm just so I'm tapped out. And they don't have access to any more credit, and the business can flounder a little bit because a business needs, well, what's right there on your screen, these three things in red. Number one, a business needs cash flow. Number two, a business needs credit. And number three, a business needs collateral. If your business has those three things, boom, 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 right? Cash flow, credit, and collateral, you then become fundable, you're lendable, you're credible, right? These are the things that all lenders look at to see if you're a legitimate business and if you're even worth the time of day looking at to give you, to see if you're worth giving a loan or a credit card to. What a lot of people do is they have a business with no cash flow, no credit, no collateral, and then they say, hey, I just started a business. I want to go apply for a business credit card, and they get denied. Or they get asked, well, give your personal guarantee. And what's that mean? Well, usually what that means is you are still getting a personal credit card. You're just making you're like a co-signer for the business. So business credit is when you don't have to use your social security number, right? You build business credit that's based off of the EIN. And we'll talk about that. So business credit. So Max's personal credit situation is all revolves around and is based off of his social security number. His social security number was on every application for every credit card. It's on the home mortgage. It's on everything. When you have a business, the business has an EIN, the employer identification number. That's the business's tax ID. It functions just like a social security number. What a social security number is to a person is what the EIN number is to the business. Now, business credit. We're talking business credit. Without going into great detail, it's very easy to build a minimum of $50,000 in lines of credit within 6 to 12 months, even if you're a business startup, right? You can do that if you're working with the right professionals. On your own, I can't guarantee that you can make that in 6 to 12 months. It could be 6 to 12 years. You've got to know what you're doing there, or you got to work with people who know what they're doing, right? But business credit, when working with a professional, you can do this in a very short period of time. It's very systematic. So getting $50,000 in lines of credit for your business in your business's name, credit that is not attached to Max personally, it's separated, right? Max is over here and the business is over here. And so now we've separated the credit. So let's take a look at some stuff here. Let's say of the $50,000 in lines of credit, we want to take $25,000 worth of it. Okay, not all of it. These lines of credit that you get for your business, it's really great because it's 0% interest for anywhere from 12 to 24 months. Let's say in this example, hypothetically, we were taking $25,000 of the corporate credit cards, CCC, corporate credit cards, at 0% interest for 24 months. What Max is trying to achieve here is he's trying to create his own HELOC through his business, but it's not a real HELOC, right? So I put there, it's sort of like a HELOC, right? A business home equity line of credit. How would he do that? Well, first of all, a lot of times if you're trying to create legitimacy in terms of showing that your business can pay bills and a lot of times lenders don't give you any credit for lending yourself money and then paying yourself back. And they're like, no, that doesn't count. You've got to pay somebody else. So in an attempt to make this a much more legitimate type of loan, we're going to have to put in the same safeguards that a regular lender would. So Max, remember, he's got this house. He's had it here for 2 years. And so what we're going to do is we're going to take the money, the $25,000, and we're going to be able to take these corporate credit cards, and we might be able to, what's it called? We're going to take the corporate credit cards and we're going to put, we're going to extend this as a line of credit. These corporate credit cards are in the business's name. And so for Max to use this, especially for personal things, you'd give him a separate credit card. Like, if you have a credit card and then you want your kids to be able to use the credit card, you get a credit card in your account in their name. Now, again, why are we doing this? Like, oh, this is commingling funds. Oh, Joseph, no. Remember, in this example, Max, he got into this position because he was using his credit cards to fuel his business, right? Or there's other scenarios where why not have your business own your house, own your car, and lease it back to you, right? I mean, you can do those. These are great tax write-off strategies. So I'm seeing here a question that came in from Christian Torres. It says, is it smart to discontinue escrow account on your mortgage to create more cash flow for paying off debt to create even more cash flow. Right. So an escrow account. Well, I mean, why is the escrow account there? It's to pay your mortgage insurance. It's to pay your taxes, right? So depending on the terms of your agreement, you might not be able to close that escrow until you have a certain amount of equity in the home. And I mean, so there's a lot of different things in place. Insurance companies might not insure you if there's not a certain amount of money in escrow. Every state is different and every deal can be different depending on the type of house it is. But let's say we're talking about in general, could that be, if you're able to close the escrow account and then you're accessing, more cash flow because less money is now being set aside, yeah, you are increasing cash flow. If same time, you're still going to have to pay your taxes and you're still going to have to pay your insurance. So if you're not setting the money aside in escrow, you're going to be setting it aside in your bank account. So, you increased your cash flow, which looks good on a bank statement. I will tell you that. Like if you're trying to get revenue-based financing where a bank or a lender looks at how much just gross revenue is coming in, that would be very helpful, right? Now, there's other lenders that want to look at P&Ls or they want to look at your tax returns and putting that into your cash flow. When after you pay your taxes and insurance, it washes out, so it's not really a benefit there. But I mean, I hope that's a thorough answer for you. I believe you're thinking outside the box, so you're on the right track. Anywhere where we can free up some cash flow, that's good. But obviously there's a reason for that escrow, and a lot of times it's contractually stipulated to be in place, so you can't undo it. All right, so great questions. Keep them coming in if you got more questions, because I, of course, know everything and have the answer. No, I'm just kidding. If I don't know the answer, then I'll ask Ray, and if he doesn't know the answer, then we'll go ask our attorney, and we'll get back to you next week. All right, is that a deal? Okay, so where we were at was we were extending the $25,000 in corporate lines of credit to Max. Now, what would be great here in this example that I was saying is Max used his personal credit anyway to fuel the business. So now he's going to be able to transfer balances over to these cards, and this is going to really free him up. But we're treating this, and we can do this one of two ways. We can either just make it a straight up loan for $25,000 and amortize it that way. We can even set up payment through the title company. Or I mean, sometimes the title company will set up a very simple loan repayment structure plan. But if you want to do something that actually is more like velocity banking or credit banking with you put all your income in and then you put your expenses on, and then you put your income in and then put your expenses on. Title companies don't know what to do with that. So that's not going to be something, but you could use a third-party processor. There's a number of them out there. We don't have to go into any depth, but there's a couple of different ways to structure this. This is a critical point why you need professionals, because if you don't do this right, you will commingle funds. And there's different ways. Is this going to be, claimed as income? Are these expenses? What is this? This is loan repayment money, so it doesn't actually count as the business's income. But if you're not keeping good books, keeping track of this, and you report that as income when it's not income, then you've got problems. So again, as I'm showing you a solution to this problem, I'm also showing you, whoa, there's a lot of hairy pitfalls that I could fall into, right? So keep in mind that that's not what we're trying to do here. Everything that we're suggesting here is, first of all, legal. These are things that we've been able to do, but these aren't things that can necessarily be done for everybody, and especially if you don't have the right professionals working with you. So you're set up. So how do you set this up? So you're putting a lien on the property. A lien. Now, Max already he owns the house, but the bank has the first mortgage. So you're putting a lien in second position. This is a second position lien or a second deed of trust, or what's sometimes called a second mortgage, right? This is what we're creating. And so you create a private mortgage note for 2 years, and I put 30% interest. I mean, you can really create any type of note as long as the numbers work. You could make it interest only. Well, I actually think you should make it principal and interest. Let's say the payment comes out to $500 a month. You can really make it work out to any amount. Again, when you're structuring a note based off of the interest rate and the term, which is the length of the note, you really can adjust what the actual payment will be. And so as long as you work something out, I recommend doing something that stays within the 24 months of the 0% interest on the card, because this way it gives actual reportable income, not the whole amount, but the business can claim the interest that's earned as income. So what do we do? So what does Max do? Well, he's not going to pay that credit card anymore. Now he's going to put his money, let's say he's having the note, he treated it like a loan. He's going to service it through the title company. So the title company is going to, even though there's a $500 a month payment, they're going to process that payment. And let's say they have their processing fee of $50, but you're putting all your money into the note, bam, then you're going to get, your business is going to get $4,950 of loan repayment. So why the title company? Because by putting a deed of trust in second position, and you need to check, every state's different. There are deed of trust states, there are mortgage states. You got to know which one you belong to. Sometimes you have to get an attorney involved to do this, depending on what state you're in. So know the real estate laws and rules in your area. But by putting it through the title company, they file that lien, that second position lien, against the property with the county that the house is in. So now it's reportable. And then by making your payment on that second mortgage through, in this case, the title company, if they were servicing it as a loan, they take out their $50 processing fee, and then the other $4,950 is loan repayment back to the business. And what does the business do with it? Well, they dump $4,950 onto their line of credit. Okay, so hopefully you guys are following along, and it's as clear as mud. Again, this is an advanced strategy here, but take a look. Just by simply doing this, we have generated cash flow. What we actually have is revenue coming in, gross revenue. So there are many lenders out there that just look to see, is there money coming in, right? Now, these are revenue-based lenders. There's also, I mean, a lot of lenders, they want more than just to see your cash flow. They want to look at a bigger portfolio, a bigger picture. When you're looking at the actual income that's coming in, they want to see your P&Ls. That means your profit and loss statements, or they want to see your tax returns, or they want to see both. And then quickly they can determine that that is not all income. In fact, most of it is largely loan repayment as you mark it out in your ledger. And so it's a very small portion of that actual income on a P&L or on say the tax returns. But making sure you have a good accountant that can accurately account for that is critical. But revenue-based lending, and a lot of people don't even know that it exists, but you can, many times, what we find is that people are able to get a third of their monthly revenue in revenue-based lending. Now, there's some higher interest rates involved there, but if you're looking at building business credit, revenue-based lending is very easy. I mean, what is revenue-based lending? Is you are basically selling your revenue at a discount to a lender, right, for getting access to money right now. Revenue-based lending is used largely for businesses that maybe need to make payroll or they need to pay some taxes, and that's not factored into the current month's budget. So something to think about. But what we have established already for this business, as you can see the gold star there, is this business now, by simply setting this all up, having built business credit, and given the HELOC to Max has created cash flow. So let's take a look. Now, in the upper right-hand portion of your screen, you can't probably see because my picture is there. I wish I could move it, but you can't quite see it. So here's what's behind my picture. I wish there was a way to move that. Oh, can I turn my camera off? Wait a minute. Let's see if this works. If I turn my camera off, let's see here. Okay, hopefully, yeah. All right. Bam. Okay, so here's what you can see. That $25,000 that was used with Max, what did he do with it? Well, he paid off, say, his car, right? He put a large chunk of that onto, let's say, his credit cards. Okay, great. So he's going to be able to pay off the credit card, his full $12,000 balance, and he's paying off his auto loan. And so what happens? So you see that little graph there showing every month he's putting the $5,000 loan repayment there, and then he's using these credit cards to put his expenses on there. And then next month he pays the $5,000, and so on and on it goes till it's paid off. It takes about, in this example, 11 months. And then after 11 months, we could actually let him use the $25,000 again. So he's paid it all off, and we could renew the private mortgage note for another year, right? And create the second HELOC. And I mean, it's usually just a paperwork thing. You pay off the first one and then but the wording of it, it's all in how you worded the note. If the note allows for a renewal after it's been paid off, great. Then you don't have to go back and refile with the county again. But you might be in a jurisdiction or a place where it doesn't work that way, and so you pay it off, and then you have to go all the way back through the title company again and file. Now, you don't have to go through a title company, mind you, right? You could go down to the courthouse yourself and file this lien yourself. You could use a third-party processor to manage the payment, right? The thing that's important is that the money comes in, and we have a way to track it. And we want to show the money's coming in and what it's going towards. This is important for bookkeeping purposes to keep excellent records. And so another thing that this also does is having a third party, right? Because if we ever were to get audited, they're going to like seeing that a third party was handling this and that everything was accounted for. But also, when Max pays a third party and then the third party pays your business, that is 1 degree of separation that allows that for some lenders to look at that and see that that's a legitimate income, versus when Max was when he was if Max borrowed the money himself from the business and then paid the business back, he can do that. That's also legitimate too. But if he's looking to try and build the business and grow the business credit and create this, then structuring it this way helps you to grow the business. And what I mean by grow the business, I mean we're trying to create synergy. We don't just want to do credit banking. That's important. But we also want to build the business credit. And here's what I mean. So after paying this down in 11 months and then doing it again in 11 months. Well, hold on. Let's see. Come on, technology, work for me. Okay. So do you see paying down this line of credit after 24 months takes the original $25,000 corporate line of credit. It gives us the opportunity to grow that line of credit to $150,000. $150,000. How is that possible? Well, as you use a line of credit, you put a balance on the line of credit. And so corporate credit is different than personal credit because utilization isn't a factor with business credit. This is why we love business credit so much, because utilization doesn't count. So what credit cards like to see, or credit card companies or banks or lenders, is that if you put a balance on there, you're paying it off more every month than what you're putting back on the card. And so we are for over 22 months, we've been doing that. A bank, whether it's their computer underwriter or it's an actual person, they check these accounts, running soft pulls every 6 to 12 months. And what can happen is that they see this activity, you're using the card every month and you're paying it down, and a lot of money's going up and down, up and down. They're saying, wow, this is really a cranking business. Let's up their limit. And so maybe in the first 6 months you get a $10,000, $15,000 increase, and then another 6 months goes by and they're like, wow, this business is still cranking. This is awesome. So you get another $10,000, $15,000, and then it's still going, and like, well, let's up it. Let's maybe double the line. And so before you know it, you get to the point where you could build up to $150,000. Now, is that going to happen in every single case? No. But what if your business started lending out its $25,000 line at zero? Remember, it's using it at 0% interest, but it's charging 30% interest. Well, great. But what happens is with this line of credit, the way it's being used, the way it's being paid off, is in 2 years period of time, you have now maybe 75,000, maybe 100,000 access to other people's money, leverage that you can use. So what do we do with that? Well, after it's paid off with the private mortgage note, now Max has to kind of look, what did he do with the second 25,000 in that year? Well, maybe he just applied that to his house. Imagine he decreasing the balance on his house now by $25,000. I mean, what's that going to do for Max? All right. Well, what's it going to do for his business? Well, his business has a equitable interest in a property, an equitable interest in a property that's being paid down very fast, mind you, right? This property just experienced 25,000K growth in its equity. And so Max's company has a second mortgage, an equitable interest. So the business has collateral. What are the three things the business needs? It needs cash flow, it needs credit, and it needs collateral, right? Personal credit, business credit. In this case, business credit is what we're talking about. So this makes the business even more lendable. What can the business do? What can Max do? Let's take a look at this. Well, what happened to Max? Well, paying off all the credit cards down to zero put his utilization at zero, which was a good thing for calculating his credit score. Now his limits all drop, but over 2 years of using them and paying them off real quickly, he can grow those back up. But also, remember, he paid off his car and he's paid down his house by $25,000, and he's paid off all his credit cards. His debt to income ratio is lower now. And what does that ultimately have? That has an impact of increasing his credit score, increasing the credit score. So Max is he's happy now. He's not feeling too bad about his situation. So now take a look at this. Max can now give a personal guarantee. Before, it's like, wait a minute, he could apply for new credit cards, but why? Because personal credit cards have limitations on you. Your utilization being a huge limitation, obviously, but there's inquiries that affect your account. And so let's just talk about those two things real quick. Inquiries and utilization does not count on business credit. It's not a factor. So instead of Max growing his personal credit, like his lines of credit, he's going to give the personal guarantee to his business. And now, because over 2 years, he's really enhanced that credit score by lowering the utilization, lowering the DTI, and increasing his credit score, he's in a position where he can help his business qualify for an additional $150,000 of corporate credit cards. Now, will he get 150? I'm saying he could get up to. We work with lots of clients in these situations, and maybe not everybody gets 150. Maybe he only gets 137. oh darn, 130. No, it's I mean, it's a realistic goal to achieve up to 150. We see people get anywhere from 75 up to $150,000. And when you use a credit banking strategy, it grows your lines of credit. So we see people grow their corporate lines of credit using the credit banking strategy. So do you see the synergy? Wow, I'm growing my lines of credit. I'm decreasing my debt. I'm increasing now my business credit. So the potential of going from starting with $50,000 in lines of credit, taking $25,000 of that, and then loaning it to yourself in a second mortgage position over 2 years, growing that line of credit to $150,000, and then increasing Max's financial situation where he can now offer a personal guarantee. Now Max is creating for his business over $300,000 in corporate lines of credit. Now, okay, bam. So before I leave the screen, I wanted you to see now Max has access to $300,000 in corporate lines of credit. What could he do next? Max could have his business just buy the house. Imagine just paying off the first mortgage. What's that going to do to his DTI? Right? Now the business owns it. Now the business could apply then for, let's say, a non-recourse commercial collateral loan, or maybe a line of credit, a business line of credit that, I mean, obviously, if he applied for a HELOC, he could get a higher loan to value. But still, I mean, he's got $300,000 in corporate credit. Instead of making payments to the bank, why doesn't he just make payments to his business? I mean, there's a lot of things that could happen. And then when Max lowers all of that debt, could he then, what could he do then? He could go and now apply for a personal line of credit if he needs to. He can continue every 6 months. Here's what's cool. You want to know what's cool? He could every 6 months after the inquiries fall off his personal credit, he could give another personal guarantee. Now, he might not be able to give another personal guarantee to the same business, but what's to stop Max from starting another business? In fact, now that I think about it, what is the limit to the total number of businesses that you're allowed to start in the United States? What is that number? I wonder, how many businesses am I legally allowed to own in the United States? I wonder. Because if I can build business credit on one business and use a strategy like this, and then in 2 years I have $300,000. I mean, it takes money to make money. I can go take my $300,000 and then go buy something worth $500,000, right? And then I could take, once I use a credit banking strategy to eliminate the rest of that debt, I can then take something that's $500,000 and leverage that to go get something that's worth maybe 2 million, right? And then once I use my credit banking strategies on that, now I own something worth 2 million. Then I use that to leverage something for, I don't know, 8 million, 9 million, 10 million. There is no limit to the number of businesses you can own. So there's no limit to the amount of business credit you can build. And when you use that with credit banking strategies, and you use credit banking strategies to eliminate your business's debt, there's no limit, folks, to the amount of wealth that you can create. What do you think I'm doing? Why do you think I own 6 businesses? Why do you think my businesses all have business credit? I'm practicing what I preach. Okay, this is an amazing strategy, and it's something that even if you're like, oh, I don't even want to go into business, that's fine. You might not have the desire to build widgets or invent something, or maybe you don't have a barber shop, or you don't own a truck or anything like that. I get it. Everybody should at least start a business for the purpose of building for your own financial freedom. The business, your financial business, can own a trust, can have its own fund. Maybe it takes care of emergency health issues, but you should create a business as a perfect vehicle. It's got tax shelters built into it, write-offs. Again, consult with an appropriate legal professional to check, make sure that everything I'm saying is true. But you start a business for the purpose of saving money in taxes, and then you're able to protect yourself liability-wise with it. And so what do you do with your business? You have your business start maybe buying rental properties that you put a property manager in charge, so you don't have to even think about it. And what happens over time? Well, tenants pay down your mortgage, so then you end up owning those properties free and clear, and then you either keep it for the cash flow or sell it, and you have a huge nest egg. But all of you should be in business planning for your, not, I mean, we want to help you get financial freedom today, but we want you to have financial freedom in the future, and we want you to have a legacy that you can pass on to your loved ones. Is that awesome? So this is a sample accounting reporting done in QuickBooks of how you got to keep track of the income that comes in, or actually it's not income, of the revenue that comes in, and what actually goes to income and what's debt repayment. And so this is good stuff. So at this point, I'm going to actually exit out of my PowerPoint here. We'll come back to this in a bit, but I want to take the last 15 minutes here, and let's go over let's go over the actual numbers that we have here for today. Let me see here. Come on. I love technology when it works. It's right now, it's wanting to work, but for some reason it's not working. Come on, little computer. I don't know what's going on. But what I do is I have some numbers that I want to go over, some credit banking numbers, and the computer is not cooperating with me. So here we go. Now, all right, there we go. It just needed some time to think. It's like I'm blowing the computer's mind. The computer is listening and going like, I can't believe this. Okay, so we're looking at some numbers here from one of our folks here. This is our Mastermind number 5 here, and this is all good stuff. What I want to do is let's go ahead and take a look at this. So the income, this is a 2-income family, and they have $10,434 coming in a month. You're like, whoa, that sounds good, right? Now, I mean, everybody has different income levels. Look at what their expenses are. $6,345.70. They've got a couple of cars, they've got a house, they've got multiple, when you pay for things with businesses, let's say you had somebody install your solar, and then you get it on sort of a line of credit that you pay off over time. You don't actually have a credit card, but so they have a lot of retail debt they're also paying down as well. So when we look at this, what is the cash flow here, right? So this is where I like to make this interactive, and I want people to say, okay, look at the income, $10,434 with expenses of $6,345.70. What is the cash flow? Does anybody remember what the formula was that I was using to calculate cash flow? Anybody? Cash flow is simply the money that's left over after you've paid your expenses. So let's take a look at that. If we put in $10,434 and we subtract $6,345.70, what do we come up with? $4,088.30. Man, come on, folks. We're looking for some audience participation here. $4,088.30. Okay, I'm gonna let you guys help me solve this one. Their available credit is at $12,251. Their current credit balance is $6,351.56. What is their utilization? Come on, folks. I'm going to give you a little bit of time. You might have to whip out that calculator, right? Right? Pull up that calculator. What do we do for that calculation? Right? You take your credit balance, 6,351, and you divide it by your available credit of $12,251. I'm not going to hit the equal sign on that yet because I want to see if anybody on YouTube or in the mastermind on the webinar has come up with it. Anyone? Bueller. All right, folks. I'm looking to see who's going to get it right. There, I'll give you a free piece of candy. You just have to come to my office to get it. Oh, hey, Ray Fleming got 51. Christian Torres, 50%. And the answer is 51.85%. William Van Dorn. Good job. All right. So this is the utilization. Think about that. So banks care about your utilization, 51.84%. So, oops, let's not do that. So we have a problem here. We have a problem right off the bat. Look at the utilization. If you remember what we talked about tonight, our utilization needs to be below 50%, right? So I already have, that's already like an indicator to me right there. So they have a lot of different loans, auto loans, and all kinds of things. But there's this home mortgage right here with 29 years left to pay. Actually, 354. It says months left. Yep, 354 months left. 350 more payments. And oh, that date. That's not the right date. That's a. Sorry, that was I accidentally put the wrong date in there. That was this was 6 months ago. The interest rate is 3.5%. So, you know, it's not a bad interest rate. But look at the payment. The payment, $2,493.49 every month. That's what they're paying on the house. So, you know, this is for that area, this is good. But what is the efficiency of this loan debt? Right? Efficiency, just so you know, is where you take your payment that you're making, your monthly payment, and you divide it by the loan amount. Why are we looking at efficiency? Efficiency is important because we need to know what debt to pay off first. So efficiency is something that we always take a look at. So if we are going to, we got to figure out what the efficiency of this debt is. So we have to take our payment of $2,493.49, and we have to divide that by the total loan amount, which is $328,610.89. Now I'm not going to hit the equals button, but we should come up with a percentage. And these are things that we talk about. We'll go over in future weeks. We'll go over all of these calculations that we make to show you where do these formulas come from. But what we're trying to do is calculate the efficiency of our money and what it's going towards. So let's have somebody Tell me what the efficiency percentage is on this particular loan. Right? Who's got that? See, the great thing about Mastermind, with it being interactive, is it gives you opportunity to play along, the audience participation, right? This is what is really important, that you'll learn something, right? Okay, so who knows what the efficiency of this debt is? Anyone? Anyone? Come on, I know you can do it. I believe in you. I know it. You know it. You can do it. Grab your calculator. Come on. You're like, oh no, it's math. Ouch, my brain hurts. I don't want to be, it's late at night, Joseph. I don't want to be thinking right now. Or if you're watching the recording of this tomorrow, then you're like, you have no excuse, right? So where are we at? What is the efficiency of this debt? The efficiency of the debt is, drum roll please. Look at that. It's not even 1%. So some of you might have been like, wait a minute, I don't know if I did it right. Right? Look at that. It's, if we're rounding, right, you're going to have 7/10 of 1%, right? 76 1/100ths of 1%, right? So we'll just round it, but we're going to say it is 0.07%. Now, what does that mean? That's a low percentage. What does that mean? Well, that means when we start looking at all our debt, then we take every monthly payment and we divide it by all the loan amounts. We'll have a range of interest, percentage scores. Your lowest interest, the lowest percentage here on efficiency is the first debt you need to pay off. It's the most inefficient debt, meaning you're losing the most money on this debt. And basically anything under 50%, you want to pay that off right away. Now, once it starts going over 50%, those are the types of loans or repayments, whatever we're dealing with, that you can afford actually to stay into. And making those payments over time is good of building your payment history. But these low efficiency debts we got to get rid of as fast as possible. Okay. So let us now go and let's take these numbers and let's put into our handy dandy credit banking calculator. All right. So of course I don't have any of this memorized. Let us split the screen here. Okay. So we are dealing with how would we pay off this $328,610.56 mortgage at an interest rate of 3.5, and the term in terms of months is 354 months left. All right. So when you look at the payment, look at that debt payment right there. See, it says $1,489.79. But then you look at their payment is $2,493.49. Well, if you're wondering what the discrepancy is, right there, you've got your mortgage interest, you've got your taxes, your insurance, your regular homeowner's insurance. There's a lot of things all wrapped up in that payment. Some of you might already know that, but other people might not know that. So we like to always help everybody get a broad understanding. Okay, let's take a look over here. So the interest rate on the account. So on one of the credit lines, they're using very low interest rate. I think it's an introductory, 0%. Now their net income $10,434, and their expenses are $6,345.70. Another thing, when we use this, so here, the interest rates, it's not going to stay 0% for long, and it's going to adjust. So you come back in and you adjust. Let's say it settles back in. The new interest rate that they get is 14%. So you go in and you make your adjustments as they happen. So here we're looking at with cash flow of $4,088.30. Okay, so now that we have all of our numbers in here, I will move away from that screen, and let's take a look here at this screen and it's in all of its glory. Okay, so here's what we're looking at here. The way this is amortized, you will pay this debt off in 354 payments, which is 29 years. 29 and a half years is what it says right here. And you will pay $198,767 total in interest. Okay, that's where we're currently at. What if, here in the orange, what if they were able every month to put an extra $500 into the principal every month? Well, that's this orange line. It shows you, oh, just by making an extra $500 a month payment, you'd end up here. There's a lot of people who have different financial strategies, and they say to do that. And as you can see, look at that. Total interest paid is only $120,373,000. So you save $78,393 in interest over, in this case, paid off in 218 years. What is that in terms of my calculator? So if I go 218 months, divide that by 12, and so you're paying that off in a little over 18 years. But that's better than paying it for 29 years, right? Now the green line here. The green line is, what if we use a credit banking strategy? And right now their credit cards for the next few months are at 0% interest, and then they'll kick up. And all their interest rates are going to vary somewhere between 9 and 16%. I just put in 14. I mean, we can change this to match, but you're going to have to figure out what your effective interest rate on the credit cards that you're using are. So we look at the net income, we subtract out the expenses, and now we see what the cash flow is. So the way credit banking works is we're going to apply all of our income into our line of credit. And then we're going to put all of our expenses on the line of credit. And so our line of credit is going to be both our checking account and our savings account. So a couple of things that we're taking into account here, or that we're assuming, is that your income, one, isn't going to change, and two, that your expenses aren't going to change. So is that realistic? Probably not. But for explanation purposes, for math purposes, it's good to take a look at this. Sometimes your income might increase. Sometimes it might decrease. Sometimes your expenses will go up because of unexpected things that happen. So you just go in and make adjustments as you go. If you're keeping track of these, and as you make your adjustments, you're able to see where you're at. But let's say the income doesn't change and the expenses don't change, then you will pay off this 29 and a half year mortgage in only 6 years. A little over 6 years, you'll pay it off. The total interest you'll pay is $59,139. You will save, as you can see here, $139,628,000. Now, what's the yellow bar here? The yellow bar is what happens if we're into paying down this house, and then we decide, you know what, we've got some equity. Why don't we apply for a HELOC? And maybe if we go through a credit union, we could get a HELOC in first position to take over the existing mortgage. Well, that would be great. And then so when we do that, we switch over, and whatever your interest rate is, it'll be variable. It could be 4%, 7%. And then once you transfer whatever the balance is, right? Because as the balance gets paid off, right, we'll be looking at, creating an amortization schedule, and we'll find out exactly where you're at, and then we plug in the number, and then that will generate, based off of the percentage, what your monthly payment is going to be. And it might be somewhere near what the payment is on a regular mortgage as well. But it'll free up, because you're not having to make such a high payment. It'll free up some cash flow for you. And then, how long would it take to pay off? Well, if you were able to put this on a line of credit today, right, it'd be paid off in 5.5 years. If the interest rate was at 4%, right, all of these things were true. But this yellow part of the program is where when we're into this for a few years, and we've developed, and we've paid down somewhere, I'd say, around where we have 40% equity in the home. And if you've been doing any credit banking or velocity banking strategy for a while, it has a positive impact on your credit score, the DTI, your utilization, all of that, so that you can actually have be in a better credit worthy position to apply for and even get a home equity line of credit at very favorable terms. So as you can see here, we're just looking at some summaries, but as you can see, not only is it faster right here, but look at that, it's cheaper. Would you like to pay off a 29.5-year mortgage in 6 years? Would you like to save $139,628? Who wouldn't? This is amazing stuff. Amazing stuff. We love doing this. So we had a couple of people ask for some information. So we always put we have people that want our contact information, and I'll show that at the end of the presentation. Christian Torres says, should I be chunking the mortgage for my car and student loan? Great question. Remember, we talked about the efficiency. You're going to have to calculate the efficiency of your loan. Now, these are just general guidelines and guideposts. Sometimes it makes more sense, if you don't owe that much left on the vehicle, to quickly pay it off and free up cash flow. But I mean, if you're into a new car and it's a 5, maybe sometimes they have 7-year loans on that, and your mortgage is the most inefficient, it might make more sense to pay off the mortgage and free up that payment, and then you could turn around and, well, in 6 or 7 years, you might just need to get a new car. So I mean, then you get a new car, and then quickly, can you pay off that new car with your credit banking strategy? Very quick. So great question. So I just want to close by thanking all of you for being on the line on this webinar. We love going over this information. Please make sure that you give CJ Wallace a lot of kudos for bringing us on his YouTube channel. Make sure you like and subscribe to his page. And if you'd like to see the recording of this and you want to go over these numbers again, look for this. This will be released tomorrow night on the Wise Guys and Ties YouTube channel, and you can go there and you can like and subscribe to us there as well. So let's go ahead and give you our contact information, because some of you might be like, hey, I would love to have the opportunity to work with you guys, or to sign up for some of these free consultations. First of all, if you want to participate, Credit Banking Mastermind, go to wiseties.com/credit banking, credit-banking. And when you do, you fill out the form. If you want to put your numbers in, you can. You don't have to, but you do have to check mark the 4 boxes before participating. It's every Tuesday night, 8 p.m., right? We go for about and we're just trying to provide as much value as we can to everyone out there. Also, I mean, it's great to if you want to consult with us, if you want to have the opportunity to work with us, and you want us to do a 30-minute free consultation where we take a look at your numbers and mastermind it, strategize it with you, we would love to do that. But you're going to have to fill out this form first if you want to do that. After you've done that, here's our contact information, folks. You can go to https://wiseguysandties.com. It's our website. A lot of great information. Our business is we do business credit, but we also do a lot of consulting for credit banking strategy. You can also email us at bizcredit@wiseguysandties.com, or give us a ring on the phone. Leave us a voicemail message, and my office manager will get back in touch with you and schedule you for a 30-minute consultation. 524-9273. And of course, you can always contact CJ Wallace on his YouTube channel here at creditwiz@investorpro.org to learn more about velocity banking, credit banking, business credit, all kinds of great strategies that will help propel you forward. What were you put on this earth to do? Right? What is your focus, your purpose, right? We all ask ourselves that, and it's the beginning of the year, and what do we want 2020 to be for us, right? Let's have 2020 vision in 2020. Let's get some clarity about our finances, about where we're going, what we want to accomplish, and let's start working with the professionals that'll help us get there. And that's what we want to do. That's what we want to help you with. And I look forward to next week, where we will go over the budget as promised. But just wanted to share with you some exciting strategies of mixing business credit with banking. I hope that was a blessing to everybody on the line here tonight. Look forward to working with all of you. Make sure you go and sign up for a free consultation, or go to our wiseguysandties.com/credit-banking and make sure that you get set up so that you're a part of each webinar and get this information. All right. I want to thank you so much. Good night. God bless.